What if I told you that the money sitting safely in your bank might be silently losing value every single day? What if gold, the ultimate symbol of wealth for 5,000 years, is no longer the king of safety? And what if crypto, once called fake internet money, is quietly becoming the new global hedge? By 2026, the battle for the world's most trusted store of value is reaching a breaking point. Gold, cash, crypto, three rivals, three systems, one winner, and millions of losers who choose wrong. But the real question isn't which one grows fastest. The real question is, which one survives when the system breaks again? Stay with me, because the answer is not what most people expect. To understand this battle, we need to rewind to something most people ignore. Money is not about numbers on a screen. Money is about trust across time. A store of value means one simple thing. Can your wealth survive inflation, crisis, war, government policy, and technological change? History shows us something uncomfortable. Every dominant money system eventually breaks. Shells. Gold coins, paper notes, bank deposits, digital balances. Each generation believes their system is permanent. Each generation is wrong. And now in 2026, we stand at another turning point. Let's break this down chronologically, because this war didn't start with Bitcoin. It started thousands of years ago. Gold didn't become money because governments said so. Gold became money because humans trusted it naturally. Over 5,000 years ago in ancient Egypt and Mesopotamia, gold was rare, divisible, portable, and impossible to fake easily. Unlike food, it didn't rot. Unlike land, it couldn't be stolen quietly. Unlike livestock, it didn't die. Kings stored it, empires fought over it, and eventually, gold became the backbone of global trade. Fast forward to the 1800s, the world adopted the gold standard. Every major currency, dollar, pound, franc, was backed by physical gold reserves. If you held paper money, you technically owned gold. This created stability, but also limits. Governments couldn't print unlimited money. Wars were expensive. Deficits were painful. And that's when the cracks appeared. World War I and World War II changed everything. Governments needed massive funding. Gold wasn't flexible enough, so they printed paper money and promised to convert later. That promise slowly faded. In 1971, U.S. President Richard Nixon officially ended the gold standard. From that moment forward, money became fiat currency, backed by government authority. Not physical assets, cash rose to global dominance. Why? Because it was convenient, because banks expanded credit, because digital payments made spending effortless. For decades, this system worked, at least on the surface. People trusted banks. Savings accounts felt safe. Inflation stayed moderate. But beneath the surface, a dangerous habit formed. Governments learned they could create money with almost no immediate consequences, and once that door opened, it never closed. The real turning point came after 2008. The global financial crisis exposed how fragile banks were. To prevent collapse, central banks printed trillions. Then came 2020, pandemic shutdowns, economic freezes, stimulus checks worldwide. In just a few years, more money was created than in decades before. Here's the cause and effect chain most people missed. More money supply gives same amount of goods, gives higher prices, gives lower purchasing power. That's inflation. By 2022 to 2024, everyday people felt it. Food prices rising, rent exploding, fuel becoming expensive, savings losing value. Cash was no longer safe. It was slowly evaporating. And this created fear. Fear always creates opportunity for alternatives. That's where crypto enters the story. Bitcoin was not created as an investment. It was created as a protest. In 2009, during the financial crisis aftermath, an anonymous creator named Satoshi Nakamoto launched Bitcoin. Embedded in Bitcoin's first block was a newspaper headline about bank bailouts. The message was clear. This system is broken. Crypto introduced radical ideas. No central authority, fixed supply, borderless transfers, mathematical trust instead of institutional trust. Bitcoin's maximum supply was capped at 21 million coins. No printing, no political control, no emergency money creation. Too many. This looked like digital gold, but to governments and traditional investors, it looked dangerous. And for years, crypto remained small, volatile, and misunderstood. until inflation arrived. Between 2020 and 2024, crypto adoption exploded. Why? Because people lost faith in traditional money. Young investors saw banks offering near-zero interest while prices doubled. Emerging economies experienced currency collapses. Capital controls pushed people toward decentralized assets. Meanwhile, institutions quietly entered. Hedge funds, payment companies, public corporations, ETF products. Crypto was no longer fringe. At the same time, gold experienced renewed interest. Central banks began stockpiling gold again. Nations like China and Russia increased reserves. Gold was reclaiming its crisis hedge role. So by 2026, the battlefield looks like this. Cash, convenient but inflation-prone gold, stable but slow and physical crypto, fast-growing but volatile, three assets competing for one purpose, preserving purchasing power. But now comes the twist. None of them are perfect, and each one carries hidden weaknesses most people ignore. Let's expose cash first. Inflation is a silent tax. If inflation averages 6% per year, your money loses nearly half its purchasing power in 12 years. No announcement, no notification, just slow erosion. Governments rarely admit this openly. But inflation benefits debt-heavy systems. It reduces the real value of national debt. So while citizens lose buying power, governments gain flexibility. Cash's biggest weakness isn't theft, it's guaranteed dilution. And this makes people search for alternatives. But are those alternatives truly safe? That's where gold and crypto face their own challenges. So now we arrive at the critical moment. Gold is ancient, trusted, and stable, but slow and centralized in vaults. Crypto is scarce, digital, borderless, but volatile and politically controversial. Cash is convenient and liquid, but constantly losing value. By 2026, the world is repeating a pattern that has happened many times before, a dominant system weakening, new alternatives rising, public trust shifting. But here's the real mystery. Which one actually survives the next global shock? Which one collapses first, and which one quietly becomes the backbone of future wealth? We uncovered a dangerous truth. Cash is silently shrinking. Gold is trusted but slow. Crypto is powerful but unstable. Three systems, three weaknesses, and one approaching global stress test. Now we go deeper into the breaking points, the failures, the hidden data, and the repeating historical pattern that will decide which store of value survives the next financial era, because the real winner isn't obvious, and it's not who most people expect. Gold's biggest strength is trust, but its biggest weakness is control. Throughout history, whenever governments faced crisis, they didn't hesitate to seize gold. In 1933, U.S. President Franklin D. Roosevelt banned private gold ownership. Citizens were forced to sell their gold to the government at fixed prices. Why? Because when systems break, governments prioritize control over fairness. Even today, most gold is stored in centralized vaults. Large reserves are controlled by central banks. Physical access is limited during crises. Gold is stable, but not always accessible. Another problem. Gold doesn't generate yield. It doesn't move easily across borders. It's slow in a digital economy. So while gold protects value over long time frames, it struggles in fast-moving financial systems. This opened space for something new. Crypto solved many problems, but it introduced new ones. Volatility is the biggest. Bitcoin can rise to 100%, then fall 70%. Altcoins can disappear overnight. Speculative cycles destroy weak investors. Then came trust collapses, exchange bankruptcies, scam projects, rug pulls, hacked platforms. These events damaged public confidence, and governments noticed. Regulation increased, tax reporting expanded, surveillance tightened. Crypto promised decentralization, but most people still rely on centralized exchanges. That creates a contradiction. Crypto is powerful but immature, and this brings us to a dangerous question. What happens when all three systems face stress at the same time? Every major financial shift follows the same cycle. 1. Easy money phase. 2. Asset bubbles. 3. Debt expansion. 4. Crisis event. 5. System restructuring. We saw it in 1929 stock market crash, 1970s inflation crisis, 2008 banking collapse, 2020 global stimulus era. By 2026, warning signs are flashing again. High global debt, Persistent inflation pressure, geopolitical conflicts, currency devaluation, in developing nations, rising interest rate instability when the next shock hits, whether from banking failures, debt defaults, or geopolitical crises, all three stores of value will be tested simultaneously. This is where the real competition begins. Let's analyze behavior during real crises. During inflation spikes, people flee cash. They buy assets, real estate, gold, crypto, stocks. During banking failures, cash withdrawals surge, crypto trading spikes, gold demand increases. During capital controls, crypto usage rises, physical gold premiums increase, digital dollars become restricted. This shows a pattern. People don't choose one solution. They react emotionally, seeking control and protection. But here's the uncomfortable truth. Most retail investors enter too late. They buy gold after prices spike. They buy crypto near cycle tops. They hold cash during inflation. The system rewards preparation, not reaction. Let's talk trends. Shaping 2026. Central bank digital currencies, CBDCs. Governments are developing digital national currencies. These allow programmable money transaction tracking, spending controls, instant monetary policy enforcement. This means future cash will likely back more digital, more traceable, more controllable. Convenience increases, privacy decreases. Institutional crypto adoption. Large funds now hold Bitcoin. Payment systems integrate blockchain. Tokenized assets are expanding. Crypto is becoming financial infrastructure, not just speculation. Gold remonetization signals central banks continue increasing gold reserves. Nations reduce dollar dependence. Trade settlement alternatives grow. Gold is quietly returning as a strategic hedge. All three systems are evolving, and that's why the answer is not pick one. Many financial influencers promote extreme positions. All in crypto, only gold is real money, cash is king. History shows this always fails. Single asset strategies collapse when conditions change. Crypto crashes wipe leverage traders. Gold stagnates during tech booms. Cash collapses during inflation. The real winners understand balance, timing, and role assignment. Each asset has a function. Cash equals liquidity, gold equals stability, hedge, crypto equals asymmetric growth, hedge. The mistake is treating them as identical. They are not competitors, they are tools. Now we answer the central question. There is no single best store of value, but there is a best strategy. In 2026, gold remains the long-term stability anchor. Crypto becomes the high-risk, high-upside hedge. Cash stays necessary for liquidity, but dangerous for long-term holding. The true winner is not gold, not crypto, not cash. The real winner is the person who understands system cycles and adapts. Wealth preservation is no longer about loyalty to one asset. It's about positioning across systems. Digital money, decentralized systems, and programmable currencies are reshaping finance. Ignoring this shift is riskier than participating carefully. People fear price swings, but slow purchasing power loss destroys more wealth than crashes ever did. Protection matters more than comfort. Those who learn continuously, diversify intelligently, stay flexible, avoid emotional decisions will outperform those chasing hype. Every generation believes their money system is permanent. It never is. Empires fall, currencies fail, technologies replace old structures. The real danger is not choosing the wrong asset. The real danger is assuming nothing will change, because history proves one thing clearly: change is inevitable, and preparation separates survivors from victims. When the next financial shock arrives, will your money be trapped inside a system you can't control, or positioned across assets that give you flexibility? That decision is being made right now, whether you realize it or not. If this breakdown helped you understand the real battle behind gold, cash, and crypto, like this video, it helps more people escape financial misinformation. Comment wealth if you want deeper breakdowns on money systems. Subscribe, because upcoming videos will expose how financial power is shifting globally. And remember, the goal isn't getting rich fast. The goal is staying rich when systems change.